Good morning. This is Dr. Finance. We are live. The markets are surging. Energy is high. SPY climbs 0.91%. QQQ leads the charge up 1.30%. Small caps, they're keeping pace. IWM is 0.84% higher. This is strength. Broad market conviction is building. But look closer, the narrative is fracturing. We see NVDA exploding higher, up nearly 4%. This is the AI engine roaring. Yet, TSLA lags. It's down 0.45%. Divergence is critical now. Tech leadership is becoming specialized. It is not homogeneous. Meanwhile, Bitcoin breaches $90,000. Up 1.61%. The digital asset class smells liquidity. It smells risk appetite. ETH follows suit, up 1.64%. Sentiment is aggressive. We are pricing in continuation. We are pricing in momentum. But pause your celebration. The macro undercurrent is turbulent. We have fresh inflation data causing concern. We have job reports signaling friction. The Fed is under pressure. The market sees green today, but the underlying policy signals are flashing amber. Today, we connect the volatility. We dissect the discord between headline exuberance and structural risk. We analyze where the smart money is positioning for 2026. This is Dr. Finance Daily. Let's get into the mechanics. The cacophony of high finance is deafening this morning. The titans are speaking. Their words dictate direction. Jamie Dimon sounds the alarm. He's worried about a correction. He suspects the Fed may not be done raising rates. Sticky inflation is his concern. This runs directly counter to the market's current pricing model. The market is betting on cuts. Dimon is betting on resolve. Contrast that with Jensen Huang at NVIDIA. He's issuing a strange warning. He tells Americans China will win the AI race. A strange geopolitical framing from the leader of the US AI charge. This suggests strategic realignment is underway. Or perhaps, strategic pressure. Michael Burry, he piles misery onto tech stocks. Oracle failing an AI debt deal. Burry targets weak balance sheets leveraging pure narrative. His position is clear. Leverage kills narrative purity. Cathie Wood remains predictable. She boots bets on AI biotech. She pairs consumer names. Her portfolio is a high-conviction bet on disruption, regardless of the immediate interest rate environment. And observe the geopolitical context. Ursula von der Leyen is fighting to bypass Trump's global trade order. Europe is trying to secure its manufacturing base. This trade friction impacts supply chains. It impacts input costs. It impacts the CPI number we just saw this morning. The VIPs are deeply divided. Some see correction risk, Dimon. Others see inevitable technological dominance, Huang, Wood. The market is currently trading on the latter narrative, but the former narrative dictates the risk budget. Remember that asymmetry. The Treasury market is where the true battle lines are drawn. Look at the 10-year Treasury yield, TNX. It is up 0.85%. It sits at 4.15%. This is significant. When the stock market rallies hard, yield should typically stabilize or fall slightly as capital rotates from long-duration risk to perceived safety. Here, the yield is climbing. This is not a flight to safety trade. This is a pressure trade. What is driving this? Inflation fears. Despite positive CPI data, which we will dissect shortly, the market is demanding a higher term premium. They are pricing in sustained growth or sustained stubbornness from inflation. A 4.15% 10-year yield fundamentally changes discounted cash flow analysis. Long-duration assets, growth stocks, speculative tech, are valued based on future earnings far out on the curve. When the discount rate rises, the present value shrinks rapidly. Why are we seeing NVDA surge while the 10-year pushes 4.15%? This is the central contradiction of the day. Hypothesis 1. AI earnings are so powerful, so paradigm-shifting, that they overwhelm the higher cost of capital. They become an outlier discount factor. The growth curve is steep enough to absorb the 100 basis point shift in the discount rate. Hypothesis 2. Liquidity injection, likely from short-term flows, is pushing equities up irrespective of fundamental valuation. This is often symptomatic of end-of-cycle behavior. The VIX is creeping up to 14.99, up 0.54%. Low, yes, but not collapsing under the weight of this equity rally. The fear index is holding steady, signaling underlying nervousness regarding the sustainability of this move, especially with yields rising. The market must resolve the tension between the 10-year and the QQQ. If 10-year breaks convincingly above 4.25%, the narrative shifts violently. Equities will feel the repricing shock. Pay attention to that level. It is the immediate technical ceiling for the bond market's current rally. We have fresh macro data. This is where the policy fog clears slightly. First, the US inflation CPI report is raising doubts about the data itself. This is crucial. If inflation data is unreliable, the Fed is flying blind. In an environment of uncertainty, central banks default to hawkishness. They wait for confirmation. They wait for stability. Second, the jobs market is weakening. Unemployment hits 4-year high. This suggests demand destruction is occurring. This is the Fed's goal, to cool the labor market. This should argue for a rate pause, perhaps even a pivot. Yet, we have conflicting signals within the Fed system itself. The Dallas Fed president suggests replacing the interest rate target entirely. Radical policy thinking is emerging as the old playbook fails. Across the Atlantic, the ECB is holding firm. Simkis says rate decisions are rather clear. Lagarde is focused on integrating Bulgaria into the euro family. They are focused on integration and stability within their mandate, seemingly unconcerned by the US inflation turbulence, for now. The US picture is one of policy friction. Jobs are weakening, dovish signal. Inflation data is suspect, hawkish implication. The market is choosing to believe the jobs data suggests rate hikes are near their end. They are ignoring Jamie Dimon's warning that inflation remains sticky. If inflation proves stickier than this week's jobs report suggests, the Fed will be forced to respond. They will choose price stability over temporary employment fluctuations. That is the institutional imperative. The market is taking an aggressive stance against that known imperative. That is a dangerous trade. Commodities reflect industrial demand and geopolitical hedging. Oil remains relatively muted in this environment, given the stock surge. We do not have specific price movements here, but the context is key. Strong GDP growth of 3.8% in Q2, far exceeding estimates, suggests underlying demand is robust. That is a bullish underpinning for energy. Gold, the traditional inflation hedge, is under pressure today, likely because the dollar is strengthening slightly against the EUR/USD move, plus 0.13%, and Bitcoin is sucking up speculative capital. When risk sentiment is high, gold often takes a backseat to aggressive growth assets. However, recall the divergence. If the 10-year yield breaks higher, if geopolitical trade tensions accelerate, Lagarde versus Trump trade order implications, gold becomes the ultimate hedge against monetary uncertainty. For now, it is overshadowed by the tech narrative. We look for gold to consolidate unless yields materially threaten the 4.30% level. The clear winner today is technology, driven by the AI core. The loser, or at least the laggard, is the automotive sector, represented by Tesla's decline. Winner focus, semiconductors, NVDA, up 3.93%. This is driven by genuine paradigm shift excitement. Everyone needs the infrastructure. The debt concern surrounding AI stocks mentioned in the general headlines confirms that some stocks in this group are overly leveraged to the narrative. But NVDA itself has the pricing power. It is the central bottleneck. Deep dive stock 1, NVDA. The breakout above $175 was decisive. The momentum is parabolic. We are in a classic technology blow-off scenario. Institutional accumulation is overwhelming any short-term profit-taking. The risk here is regulatory or a sudden tightening of credit for smaller AI players who rely on NVDA hardware. But today, the momentum dictates the trade. Buy the strength, but respect the volatility. Loser focus, automotive, TSLA, down 0.45%. This is price action indicating competitive pressure or general risk-off sentiment within non-AI hardware plays. Elon Musk's comments are often tangential, but his focus remains shifting, from pure EV to AI software and robotics. The market is temporarily less convinced about near-term volume growth versus the sheer perceived scarcity of AI compute. Deep dive stock 2, TSLA. The failure to hold recent support levels suggests momentum has stalled. When the broader market rips, laggards get exposed. If the 10-year yield climbs higher, capital will flow out of these capital-intensive manufacturing plays faster than out of pure software, IP plays like Microsoft or NVIDIA. Watch the $470 support level closely. A break below signals a deeper rotation away from hardware capex plays. Bitcoin is having a phenomenal session. BTC USD at $90,051. Up 1.61%. Ethereum is strong too. What is powering this? Liquidity saturation. When equity markets are buoyant and macroeconomic uncertainty rises, speculative capital seeks uncorrelated or differently correlated assets. Crypto is successfully capturing that excess liquidity. Michael Saylor's firms face exclusion from some indexes. This indicates potential institutional friction, but for the retail and high-risk institutional investor, the trend is clear. Bitcoin is being treated as a legitimate, high-beta asset class alongside high-growth technology. The price action suggests we are firmly in discovery mode. We are not consolidating near previous highs. We are pushing through them. The narrative of scarcity is winning against fears of regulation or macroeconomic tightening. The key correlation to watch is the relationship between BTC and the Nasdaq 100, QQQ. As QQQ flies, BTC follows. Today, BTC is slightly outperforming QQQ's 1.30% gain. This is a sign of aggressive risk-on behavior. If QQQ stalls, crypto will follow rapidly, perhaps accelerating the downturn due to higher leverage ratios in the derivative markets. Our strategy must be nuanced. We have institutional warnings flashing against retail enthusiasm. Rule 1. Respect the yield. The 10-year at 4.15% is the fundamental speed bump. Do not ignore it. Any move towards 4.25% requires immediate portfolio stress testing, especially for long-duration tech outside the AI hyperscalers. Rule 2. Confirm leadership. Ensure the rally remains led by the fundamental disruptors, NVDA, select AI infrastructure. If the rally broadens unnecessarily into marginal names without strong earnings traction, that signals a momentum-only squeeze, which is unsustainable. Rule 3. Hedging. The VIX is flat, not falling. This signals that volatility traders expect bumps. Maintain hedges against sharp overnight risk reversals. Dimon's warning about a correction is too loud to ignore entirely. Scalp longs on strength, but keep dry powder ready for a 1-2% dip that tests conviction levels. We are trading a bifurcation. Growth powerhouses versus macro headwinds. Position lightly into the momentum, but heavily into the hedging required by the bond market data. We closed today on an electric note. The equity markets are chasing the technological future. The chips are running hot. SPY up, QQQ roaring. But the architecture supporting this structure is creaking. The 10-year yield is signaling that the cost of doing business, the cost of future capital, is rising faster than the market wishes to admit. CPI data uncertainty exacerbates the Fed's dilemma. The market is currently betting that innovation will outrun policy restraint. This is a high-stakes gamble. My institutional perspective remains cautious. While the AI narrative commands capital now, the macroeconomic foundations are suspect. Remember the warning signs embedded in the rising yield curve and the conflicting central bank rhetoric. Be dynamic, be precise. Do not confuse today's price action with tomorrow's reality. This has been Dr. Finance Daily. I'm Dr. Finance. We'll see you tomorrow. Good trading.